View attribution is usually not a good thing to have in your account. You're basically telling Meta that you value those conversions as much as a new customer conversion. But in reality, you can't.
Cash basis cost of goods sold. It means you recognize your cost of goods sold in the month that you pay for it, not in the month that you sold the product. Yeah, it's way easier, but it basically renders your P&L completely useless and your balance sheet. All right, we're back. Episode 25. What's cracking, Dylan?
Been told I'm about to get a question, John. You got me scared, man.
Okay. What does our firm and your firm have in common?
Oh no.
There's a lot of things. It's such a trick question. It's that we both manage accounts for people. We manage.
Yes.
We're managing lots of different accounts, but I'd say probably the most obvious one or the most pervasive one is we manage QuickBooks and general ledger accounting accounts. And you guys are managing, amongst other things, ad accounts, Klaviyo accounts. And today we're going to talk about mismanaging accounts. What are the most common red flags that you see and I see in our respective areas of the e-com space on account mismanagement? So I'd love to start on the marketing side of the world. I'm actually really curious. What is the single most common red flag that you find in that suggests that an ad account may be mismanaged?
The single biggest one. So like outside of just like horrific things in terms of like probability of success, like running like link click optimization or something. I mean, sometimes on top of funnel, maybe eventually, but for most brands, no. But for most common things we see from brands that are, purchase conversion optimized, et cetera, it's view attribution. View attribution is usually like not a good thing to have in your account. There are exceptions if you're very first-time customer dominant and some accounts just behave differently. But by and large, if you have view attribution, that type of conversion in our experience when measured with third-party tools is often more correlated with return customer sales. And you can kind of prove that out by looking at your new customer versus return customer performance when you run a click only versus click plus views. Now, this is not always the case, but the vast majority of times we audit a brand that's, say, doing more than like mid 7 figures per year in sales. If they're running view attribution, we'll often just remove it, and then new customer efficiency gets better like that. So that's the most common kind of red flag I see in ad accounts. In email accounts, it still happens like a surprising amount, but like using no segmentation is probably one, just like full list sends. There are, again, exceptions. Occasionally we'll come across a brand that sends so infrequently and has such a loyal customer base that it works. And then the other one would be building emails that are just fully image files. So when you use no HTML, it increases the probability a lot of you landing in the promotions tab or spam if you just have a giant image file. So a lot of people, when they design emails, will just like make a giant image file on like Canva or some other tool, and then basically just port it over into Klaviyo or whatever email solution they're using. And it looks great. And it's tempting to do that because when you do it that way, it can look nicer. It's easier to make it look nice. You can still make it look really nice without it, but it's easier to make it look nice. And then you port it over and then the performance sucks. So that's probably the two big ones we most commonly see. I can think of others, but in terms of like just like most frequent when we're doing audits or like taking over a new account.
Interesting. That's super interesting. Can you double click into the view attribution one a little bit more? Like,
yeah.
What does that mean for just like the average person listening to the show that may not understand how this all works? And what do you have a hypothesis or maybe you guys have proven to some degree as to why that tends to drive more returning customer kind of visibility as opposed to new customer acquisition?
Yeah. So the essentially, to be very clear, I'll use Meta because it's the most common one. The default attribution setting tends to be 7-day click, 1-day view. That means that someone who clicks and then purchases within 7 days will be attributed as a sale with some error bar. And then the same can be said for views. Views is basically has seen an ad and then purchases within 1 day. The reason why we do not like views is because oftentimes who is actually going to just look at an ad, not even show the intent of clicking, and then proceed to purchase? It tends to be people who are already very much middle of funnel or bottom of funnel, and a lot of those people are also often past purchasers. And uh, versus the click, yes, some of them might be return customers as well, but a lot of them are new. Whereas think about it like this: the ratio of people who click then buy might be 50% new, 50% returning for a very big brand. For a lot of brands, it's going to be mostly new customers. But for Vue, that percentage of new versus returning, you can speculate based off of how the data actually shakes out when you run click only. It's probably predominantly heavily bottom of funnel or return customers for a lot of brands. So because that is the case, when you run it, you're basically telling Meta that you value those conversions as much as a new customer conversion. But in reality, you can't. And the reason why that's key is because if someone, or you shouldn't, the reason why that's key is because someone who's bought before, they may also be getting emails from you, texts from you. And then how do you prove that they converted because they got the ad? Maybe they would have converted anyways on these other channels. So by removing it, you then basically are telling Meta to push more of your spend to the optimization of the people who are clicking and buying. And that's generally why we'll see better new customer performance. Some people will take the stance that, okay, 7-day click, 1-day view is fine. You just have to adjust your bids to take into the account the over reporting. And I tend to disagree with that. And the reason why is because just by including the view, you're still telling Meta that you value that signal, and it's going to take that into account in the delivery. So this is like technical in terms of like how you attribute, and attribution is a little bit of a mess in all things advertising. But by and large, like 9 out of 10 businesses or some similar ratio, I'm a believer, should just run click only attribution. The exception is like heavy first time customer dominance, and then like brand new brands. And then when you're a brand new brand, you want to get as much data as possible into your ad account. But like for any established brand, 5 to 50 million plus per year in sales, I don't like Vue.
Interesting. And is the reason why you can make an exception for like a heavy new customer dominant brand because like given that they are heavy new customer dominant, there's just a low likelihood or like returning customer sales is negligible, I guess.
Exactly.
Right. So like
So
you don't have
it's
to
like,
worry about it as much.
exactly. It's like the conversions you feed into your campaign are somewhat based on the attribution setting you use, and that informs Meta how to deliver your ads. So if you want to look at your account, and like and this is often a key indicator, is if you run a 7-day click campaign and a 7-day click 1-day view campaign with the exact same budget, same offer, similar setup, you'll often find the frequency on the 7-day click 1-day view campaign is way higher than the frequency on the 7-day click only campaign. The frequency is how many times on average someone has seen your ad during the time period you've selected. And the 7-day click might have a frequency of, say, 1.5 in the last 7 days, and the 7-day click 1-day view may have 2.5. Why would that be? It's because that campaign 7-day click 1-day view is just showing ads to the same people over and over again more frequently than, say, the 7-day click, which again is very much middle of funnel, bottom of funnel advertising. And the reason why this all matters so much is because you can add exclusions in your ad account to say, hey, Meta, please target this group, but exclude my past customers. The problem is it's not perfect at doing that. In fact, I don't think it's very good at effectively doing that. And it's not all Meta's fault. That's a whole like iOS thing, partially. But at the end of the day, in order for it to be as effective as possible, you want to stack as many setup variables in your favor to accomplish your target, which for most people listening to this podcast is probably get more new customers at an efficient cost. But not only do you want to have the exclusions on the audience level, but to take it a step further, you want to make sure the attribution setting is set up right. And in our experience, the attribution setting often matters more than the exclusion.
Mm. You know what's interesting? And like this is speculation. Let me be clear about this. But we've encountered so many agencies that aren't thinking the way that Aplo is in terms of like thinking about new customer acquisition separate from driving like retention. Now, I'm not saying there's not overlap. I'm saying like we're measuring new customer acquisition separate from retention from a performance standpoint, profitability standpoint. There's a lot of agencies that are clients before they started working with Aplo. They were just saying, I'm trying to hit this MER at this ad spend, right? And so it wouldn't necessarily be make a lot of sense to care about this in the same way that you guys care about this. Am I wrong about that? I'm just speculating based off like previous experience, but like you guys so heavily measure new customer versus returning customer performance that this is a big deal. But I think there's maybe a lot of ad agencies who aren't thinking in that manner.
Yeah, so I was actually interacting with another ad agency recently because we were engaging in a different capacity, and I actually thought like the vast majority of how they acted and their strategy was really really good. Creative was great, and I thought a lot of what they did was really good. But they were failing to break out the attribution between new and return customers from their advertising and activities, and there is a time and a place when you can attribute both new and return customers to ads, because the truth is that ads do also drive return customer sales, even sometimes when you don't intend it to do so. The issue is you can't measure those two things the same. When it comes to new customer, and when people do measure them the same, or when they do measure them, they tend to measure them the same. So, for example, when it comes to paid acquisition, what your goal is you're trying to effectively identify where was the initial source of demand creation, and the initial source of demand creation is ideally going to be the ad in this case if you're trying to optimize for ads driving your sales. So oftentimes you're going to look at your new customer ROAS. In some cases, you're going to use third-party attribution tools to look at like first click new customer reporting, total impact, triple attribution, can go down the list of different attribution tools, or just look at meta new customer reported sales. When you look at return customer sales in say a platform like Meta, the problem is that it's you can't just look at that because there's probably way more touch points that actually actively yielded the sale. In the case of the new customer, I don't actually care if the welcome email number 7 had a click that led to conversion, or a random campaign on SMS, because I can prove or look at and say, hey, we wouldn't have had that person on the email list in the first place had we not ran the ad on top of funnel. So I'm going to attribute as much back to that ad as possible, because without it, the rest of the funnel runs dry. Whereas on retention with return customers, what happens is, yes, a click may lead to a conversion, but would they have converted anyways? Because I was also hitting them with emails, texts, push notifications, organic posts, go direct mail. Like you can't attribute all the value to that click. So you can do things like 1-day click, last click measurement. You can do a bunch of things to try to validate that it's an effective return on an investment. It's not a one size fits all to all brands in my experience when it comes to return customer measurement. But the most important thing is basically if you're working with an agency, you want to make sure that if you're trying to grow your business, you're probably setting new customer targets. And I have nothing against measuring return customer sales through ads. I think it's sometimes not the most useful exercise for some brands, but in many cases, if you're going to take the time to measure it and assess it, you just want to make sure it's done with different rules than first time customer sales.
Yeah, it makes sense. I mean, if there's one thing that I have learned and our team at Free to Grow has learned a lot about working on the mutual clients that our two firms have, it's thinking about new customer acquisition separately from returning customer sales, and thinking about for this specific brand and like how to think about what measures success in each of those streams of revenue. And it goes for, I think maybe there's a lot of people in my experience in the e-com world who like think intuitively about that if you're a high LTV brand, right? Or like a consumable. But it's just as important if you're a different type of brand, new customer dominant or the high SKU / apparel brand. Like, and I think probably in one of our next episodes, we'll talk about the different strategies for those different games. But in all of them, you think about what is required of new customer profitability, and based on what returning customer profitability contributes to the economics of the business. And when you're not thinking about that and you're just jumbling everything all up together into one blended full funnel ROAS or MER and just blended contribution margin dollars, you're missing a lot of intel that you can use to drive better profitability as you scale. And so anyways, that's super key. So I get what you're saying.
Yeah. And I think that like the other biggest red flag that we come across, and this is kind of how it informs our strategy and recommendations, is like the for financial cost inputs. Is like not understanding your landed COGS clearly, not understanding your variable margin, having no understanding of what you want your profit targets to be, or cash flow targets to be, or this or that. I guess that kind of leads into my question is like on the finance side, what are some of the most common red flags or major issues you guys see?
So these are all like super interconnected. So like I was having a hard time parsing them out, but I wanted to do it from the standpoint, they all kind of have similar resulting issues, or they kind of like drive the same resulting issues. But the first one that we always see is just poor chart of account structure on the P&L. And what that usually looks like is, one, chart of accounts isn't separated between variable and fixed costs. And then two, if you have more than one sales channel, every variable cost in your business does not have its own sales channel subledger, either through a sub account or like tagging or something like that. What does that mean? It means, one, you can't even assess the blended unit economics for the entire business, right? Because you can't calculate contribution margin just using the P&L chart of accounts. And so you can't use that to, like you were kind of alluding to, assess CAC targets, right? And things of that nature. And then you also can't assess how contribution margin or unit economics, it is different in each sales channel, and how each sales channel is contributing to the business's profitability. I think at some point, man, this is for sure another episode, we need to talk about how to think about the unit economics of like different e-com channels, kind of combined and separate. I know we've talked about that a bit on previous episodes, but the bottom line is a lot of brands don't even realize how different the unit economics are on, say, an Amazon channel versus a Shopify channel, or versus wholesale. So that's super huge.
Or even LTV by channel. Like
Totally.
a lot of people wouldn't consider this a different channel. Maybe they would just lump it with D2C, but like TikTok shop LTV compared to D2C LTV, like, oh, that's a big difference.
Totally. And so I think that's the first one. And you see it right away when you look at the P&L and you're like, okay, I don't see these key, like, I don't see product cost of goods sold. I don't see shipping, fulfillment, credit card fees, Amazon fees, broken out. And so that's pretty obvious. The next one is, there's two others and I don't know which one is more frequent. They're both so common. Well, I'll go with cash basis cost of goods sold.
Every time you say that, it just stresses me out.
I know, dude. I mean,
so much.
Well, I mean, because the thing is, cash basis cost of goods sold. So for those of you that maybe don't know what that means, it means you recognize your cost of goods sold in the month that you pay for it, not in the month that you sold the product, right? And so what ends up happening, is it much easier than doing what's called accrual cost of goods sold? Yeah, it's way easier, but it basically renders your P&L completely useless and your balance sheet. But we see this all the time. Like when we spread COGS as a percentage of revenue month over month, when we see it go up and down, almost 100% of the time, cash basis COGS. Then we'll go to the balance sheet and we'll see there's no inventory there, or it's the same number every single month. And it's been like that for a long time. Those are kind of the red flags. Again, going back to how it's tied to the same issue for you guys and trying to understand unit economics to set marketing targets. One, we don't know what our monthly unit economics are, because one month our margin is super overstated because COGS is too low. And then in other months it's understated and it goes back and forth. But furthermore, it really messes up. I think that's obvious when you see it and it gets explained to you that like, oh, this is distorting the P&L and I can't tell if my margins are getting better or worse every single month. But on the balance sheet, when you don't have an accurate inventory valuation, you can't calculate very key metrics that help you assess balance sheet management, cash flow health. You can't assess inventory days, which means you can't assess the cash conversion cycle. And then you also can't assess liquidity or net working capital properly, which is like kind of comparing your liquid assets to your liquid liabilities. And when you have your biggest liquid asset oftentimes, or your biggest current asset that most brands have on their balance sheet is typically inventory. You just can't assess liquidity or solvency, which is the ability to meet your short-term obligations.
And to put it into like practical terms from my perspective, this also means that you're going to be in a much worse position to accurately decide how much you can invest to refuel your growth, and also how much you can afford to pay yourself, because cash flow management becomes like pure chaos. You're going to basically have the risk of bottlenecking the business growth and distributions, both of which sucks. So having this dialed is like super, super key. Not, and then you can go down the list and say, just to give the marketing team what they need, because that's what we're used to. But I think it's super, super important.
Well, I would say actually probably, and we'll go over a couple more, but this is the cash basis cost of goods sold is probably the biggest issue that affects multiple areas of trying to manage the business. Because like I mentioned, it doesn't just affect like the ability to set sound marketing targets, but it also completely screws up your balance sheet, and you just can't, like, look, when I look at a balance sheet, I look at lots of balance sheets every single year because I do all of our CFO audits for prospects, and like inventory is almost always the biggest asset number on the balance sheet, right? And so if you don't know what the biggest potential consumer of cash on your balance sheet is, inventory, if you don't know what the balance is, you don't know if it's getting better or worse, how does that relate to sell-through? How does it relate to cash on hand? How does it relate to my debt levels? If you can't measure that every single month, you're completely hamstrung on like running the business from a financial perspective in a sophisticated manner, and ultimately making capital allocation decisions, right? Balance sheet management, such that like in the context of cash management, it's kind of like a seesaw, right? It's like this balancing act where you've got assets on one side of the equation and you've got liabilities and equity on the other, right? And if you want as and even within, let's just talk about within assets, the seesaw, right? Inventory goes up, all other things held equal, cash goes down, right? Inventory comes down, all other things held equal, cash goes up. And so if you can't look at that balancing act, that seesaw on different sides of the balance sheet and within the same side of the balance sheet, your CFO can't do things like say, hey, listen, if we want to free up more cash, we need to reduce inventory by this much. We need to reduce receivables by this much, and let's negotiate with our vendors to increase payables by this much. You can't do that, right? And furthermore, actually, here's another real big issue. On the other side of the cash conversion cycle is AP days, right? If you're recognizing COGS in the month you pay for it, guess what else you're not booking on the balance sheet? You're never booking a payable. You're never booking the invoice, the bill you got that says I owe the vendor in 30 days or I owe the vendor in 10 days. So you can't even see a snapshot of what you owe to vendors in the next 30 days because you're not booking a liability. You're just booking COGS as an expense when you pay for it. So it's actually, you look at cash on the balance sheet, you don't even have a complete current liability section on your balance sheet, which you should generally back out from cash to see, like, if I paid all my current liabilities, how much cash do I have left? So it affects both sides of the balance sheet, and it's just risky business.
I have a little bit of an unrelated question, but from your experience with all the audits, like, do you most frequently come across brands that you think of like an excess amount of debt they're utilizing to fuel growth, or is it more so the other side where it's brand operators who have less experience using that to fuel growth, and you kind of help them identify how it may be a leverage point to get better returns?
I see both, but the more common one is brands being over leveraged, or
Yeah.
the amount of leverage is okay, but they're using the wrong kind. Like that's too short term, or like just it doesn't match the actual need. But I do get excited. I get excited when I see a brand that's under leveraged and profitable, because like there's a lot of opportunity. There's a lot of low hanging fruit of like, hey, look, let's bring in a healthy amount of debt to, especially when there's a brand with high LTV that's under leveraged with debt. I'm just like,
It's my favorite acronym, John.
Yeah,
Favorite
like-
acronym.
yeah. The other one that comes to mind that's a big red flag that we often see that I want to finish up with here is basically like merchant payouts getting coded directly to revenue really on a cash basis. So like, what do I say when I mean that? I mean like Shopify and Amazon payouts. When those payouts hit your bank account, say your Chase bank account, that transaction, that payout transaction is what the accountant is booking straight to revenue. But there's multiple issues with this. One, they're dating it for the day that it hits your bank account, not when in reality that's a batch of order payments from previous dates, right? So you can get revenue in the wrong periods, again, affecting your ability to understand unit economics and profitability. But even more so, the real problem is that those batches, they don't just include net revenue. They include gross revenue minus discounts, minus refunds, plus sales tax collected, right? And even plus shipping income. And so when this is happening, payouts are getting booked net straight to revenue on the date that they hit their bank account. We see no sales tax payable on the balance sheet. Big issue, because that's a liability that you owe someone. And so you need to see that on the balance sheet so you know to subtract that from available cash. 2, there's no bifurcation of gross, discounts, and refunds on the P&L, which are very important unit economics to track every month. There's no merchant fees, so no credit card fees, no Amazon fees as variable costs. And I would say even probably the worst out of all, those are all bad, but net revenue is being reported as effectively what's actually net revenue plus sales tax collected. So the denominator in all of your margin calculations, gross margin, contribution before ads, contribution after ads, all those percentages are wrong because the denominator, net revenue, is wrong. And so because of that, that is a huge issue, and we see that all the time.
Yeah, that makes complete sense. As you see brands go omnichannel beyond beyond D2C, is there any other ones like the on Amazon or wholesale that are most common, or a lot of the issues? I guess some of these also kind of apply to all channels.
I would say the most common one that we see when a brand goes omnichannel, and I'll just define omnichannel as like Shopify, Amazon, and wholesale, is that their product cost and or shipping cost freight out is not bifurcated across channels. You'll
Yeah.
usually see Amazon split out if it's FBA because it's easy to identify that. But there is some challenges in being able to wrangle your data from, say, your 3PL to break out wholesale shipping from D2C shipping, right? Or you might not have some brands don't have the right kind of system in place to allocate product cost to each channel. But that's what I see most frequently.
Got it. That makes sense.
Well, this is some good stuff. What are your final thoughts on this topic, Dylan?
I think that there are obvious red flags across any discipline in your business. When it comes to marketing, I think at the root of all of them is when the financial KPIs and data are not properly aligned with the finance and or founding team with the marketing team. So back to what we were talking about earlier with attribution settings and optimizing for new customers. If new customer outcomes as a KPI is not a priority and you're operating under MER, that makes it easier and more common for people to just start looking at in-platform reporting. Not always, but I think when you start drilling down to the specifics you want to yield out of the business, which for many brands is going to be new customer acquisition via paid ads, you want to make sure that you're changing the account in line with those targets. And to properly set those targets at a more granular level, you're going to need to have the financial inputs in place and make sure those are actually accurate.
For sure. Yeah. And I would say my final takeaways are or my final thoughts are, look, all the red flags I went through, they're super common. So if you think you're seeing some of these, there's a good chance you are. I come across at least one of these almost every single time I encounter a new brand that I'm talking to. And I would say that if you think you're experiencing this and you go to someone to try to help you to try to help you implement a fix, I would say ask them, why does this matter? That's the key. Why does this matter? And as a general statement, all the red flags I went through, they matter because they hamper your ability to do incredibly important things to keep your brand profitable and cash flow positive as you scale. So anyways, I think this is a great one, man. And hey, look, we're moving on to episode 26, the half-year anniversary, baby.
Oh, yeah.
Let's go.